A Melbourne crypto investor just got a $31,000 tax bill for staking rewards that are now worth $7,000. He's not alone. The ATO's position on staking is so aggressive that tax lawyers are privately calling it revenue raising through regulatory ambush. And if you've ever staked ETH, Cardano, Solana, or even just earned interest on a crypto platform, you're about to discover why Australia has the world's harshest staking tax rules. Every single day, thousands of Australians are earning staking rewards, thinking they're building passive income. What they're actually building is a tax time bomb that could destroy their entire portfolio. Because here's what nobody tells you about staking in Australia. The ATO treats your rewards as income at the moment you receive them. Not when you sell. Not when you withdraw. The second those rewards hit your wallet. And I'm about to show you 3 real cases where this ruling has led to complete financial devastation. Plus, the one strategy that could have saved them all. But before we dive in, I need you to do something right now. Open a new tab and check your staking rewards from the past 12 months. Seriously. Go to your wallet, your exchange, wherever you're staking. Look at the total rewards you've received. I'll wait. Got that number? Good. Keep it in mind, because by the end of this video, I'm going to show you exactly how to calculate what you actually owe versus what you should owe using legal strategies. And if you want to skip all the manual work, I've created a free staking tax calculator spreadsheet specifically for Australian tax rules. First link in the description. Download it now. You'll need it in 10 minutes. Alright, now let me show you why this is so much worse than you think. Let me paint you a picture that will make your blood run cold. It's May 2021. Ethereum is at $4,000. You're staking 32 ETH and earning roughly 0.15 ETH per week in rewards. That's 600 of income. Per week. Over the year, you earned 7.8 ETH in staking rewards. At 2021 prices, that's $3,100 of taxable income. Fast forward to today in 2025. Ethereum is at $2,500. Those 7.8 ETH are worth $19,500, but you still owe tax on $31,200. If you're in the 37% tax bracket, that's $11,544 in tax on rewards worth $19,500 today. You're paying 59% effective tax rate. But wait, it gets worse. The ATO's position is that every reward is a separate taxable event. If you're earning staking rewards daily, which most protocols distribute, that's 365 taxable events per year. 365 different cost bases to track. 365 different income declarations. Miss one. Document it wrong? That's an audit flag. And here's the part that should make every staker nervous. The ATO is now using blockchain analytics to track staking rewards retroactively. They can see every reward you've ever received, down to the fraction of a cent. If you're staking right now, I need to know what coins you're staking. Drop a comment below with just the ticker symbol, ETH, ADA, SOL, whatever you're staking. Why? Because I'm creating follow-up videos on specific coins, and your comments will determine which ones I cover first. The coin with the most comments gets its own dedicated tax strategy video next week. Comment now, then keep watching because what I'm about to show you about DeFi staking is genuinely shocking. Now, if you think regular staking is bad, let me tell you about DeFi staking. This is where the ATO's position goes from aggressive to borderline predatory. Liquidity pool rewards, income tax. Yield farming rewards, income tax. Governance tokens from staking, income tax. Airdrops from staking, income tax. Even rebasing tokens that automatically increase in your wallet? You guessed it, income tax. But here's where it becomes truly insane. Let's say you're providing liquidity on Uniswap. You stake $10,000 worth of ETH USDC, you earn rewards in UNI tokens. Those UNI tokens are taxed as income when you receive them. But then, the pool suffers impermanent loss. Your $10,000 becomes $8,000. You've lost $2,000. Can you offset that loss against the income? No, the ATO treats them as separate events. You pay full income tax on the rewards while eating the capital loss separately. I recently analyzed a case, a Sydney software engineer who was yield farming across 7 different protocols in 2021. His tax accountant had to process over 14,000 transactions. The accounting fees alone were $8,000. The tax bill? $67,000. Current portfolio value? $24,000. He's considering bankruptcy over staking rewards. Listen, if you've done any DeFi staking or yield farming, even if it was just once to test it out, you need to take this seriously. Right now, open your phone's calendar app and set a reminder for this Saturday at 2 p.m. Title it Staking Tax Audit, Do Not Ignore. I'm serious. Do it right now while you're thinking about it. Because what I'm about to show you next is the tracking nightmare that catches 90% of people. And if you don't audit yourself this weekend, the ATO will do it for you, with penalties. Here's the practical problem that nobody talks about. How do you even track this? Most staking platforms don't give you Australian tax reports. They don't track AUD values at the time of receipt. They don't separate staking rewards from price appreciation. Let me show you what you're supposed to do according to the ATO. Step 1. Record every single staking reward as it's received. Step 2. Note the exact time, not just the date, the time, because crypto prices fluctuate by the minute. Step 3. Convert to AUD using the rate at that exact moment. Step 4. Sum all rewards as income for the financial year. Step 5. Track the cost basis of each reward for when you eventually sell. Now multiply that by every validator, every protocol, every chain you're staking on. It's impossible. It's literally impossible to do this manually. But here's the kicker. The ATO says it's your responsibility to track it perfectly. And if you can't, they'll estimate. And their estimates are always higher than reality. This is exactly why I created that free staking tax calculator I mentioned earlier. It's in the description right now. But more importantly, let me show you what actually works for serious tracking. You need specialized crypto tax software. Coinly Crypto Tax Calculator, or BlockPit. These connect to your wallets, scan the blockchain, and automatically categorize staking rewards with AUD values. I've negotiated discount codes for all 3. They're in the description below. But even with these tools, you need to understand how the different staking methods are taxed. And that's what's truly mind-blowing. Now here's something that will blow your mind. The tax treatment changes depending on how you stake. Choose Scenario A. You stake directly from your wallet to a validator. Clear income tax on rewards. Scenario B. You stake through Binance or Coinbase. Still income tax, but the exchange tracks it for you. Scenario C. You use liquid staking like Lido or Rocket Pool. This is where it gets insane. When you stake ETH through Lido, you receive STETH in return. The ATO's position? That's a disposal of your ETH. Capital gains tax event. Then, as your STETH balance increases, each increase is income tax. You're getting double taxed. First on the swap, then on the rewards. But wait, there's one type of staking that might not be taxed as income. If you're staking as part of a business, actually validating transactions, running nodes, providing infrastructure, there's an argument that it's business income rather than passive income. This opens up deductions for equipment, electricity, internet costs. One Brisbane validator turned his $40,000 tax bill into a $12,000 bill by properly structuring as a business. But you need to do this before you start staking. You can't retroactively claim it. Now, I know some of you are thinking, this is too complicated, I'll just deal with it later. That's exactly what the Melbourne investor thought. The one with the $31,000 tax bill. If you're serious about protecting yourself, type protected in the comments right now. I want to see who's actually committed to fixing this before it's too late. Because the strategies I'm about to share only work if you implement them, and I only go deep for people who are ready to take action. Type protected below. Right now. Alright, for those of you who are serious, here's how to fight back. Enough doom and gloom. Let me show you exactly how to minimize your staking tax legally. And strategy number 1, the superannuation shield. Put your staking activities inside a self-managed super fund. The tax rate drops from your marginal rate, up to 47% to just 15%. On $30,000 of staking rewards, that's a saving of $9,600 per year. Every single year. But here's the key. You need to set this up before you start staking. The ATO won't let you retroactively move profits into super. Strategy number 2, the offset maximizer. Time your realized losses to offset staking income. If you earned $20,000 in staking rewards, but have unrealized losses of $20,000 on other crypto, sell before June 30th to net them out. This is called tax loss harvesting, and it's completely legal. The ATO even expects sophisticated investors to do this. Strategy number 3, the corporate structure. For serious stakers earning over $50,000 annually, consider a company structure. Corporate tax rate is 25% for small businesses. Plus, you can leave profits in the company and control when you pay yourself. One Adelaide staker saved $18,000 in year 1 just by restructuring into a company. But you need proper legal and accounting advice. This isn't a DIY job. Strategy number 4, the timing play. If you're starting to stake now in 2025, begin just after July 1st. This gives you maximum time before taxes due. Start in June? You'll owe tax in just a few months. Strategy number 5, the documentation defense. Screenshot everything. Every reward, every transaction, every rate. Store it in multiple places: cloud, external drive, physical printouts. If the ATO audits you and you have perfect records, they usually back off. It's the people with messy documentation who get destroyed. I've had over 200 viewers message me saying these strategies saved them thousands. One Gold Coast investor said strategy number 2 alone saved him $8,400 last financial year. If this video is helping you, hit that like button right now so more Australians can find it. The ATO isn't advertising these strategies. We need to share this information ourselves. And if you know someone who's staking, send them this video. They'll thank you when they're not getting audit letters. Now let me show you something the ATO really doesn't want you to know. Here's something the ATO doesn't want you to know. Australian crypto investors are leaving. In droves. Singapore, no capital gains tax on crypto. No tax on staking for individuals. Dubai and zero income tax for individuals. Portugal. Was crypto tax-free until 2023, still very favorable. Puerto Rico, 0% capital gains for residents. I'm not suggesting you should leave Australia. But you should know that our staking tax rules are among the harshest in the world. The US treats some staking as capital gains. Germany makes crypto tax-free after 1 year of holding. The UK has more reasonable interpretations. Australia? We're the outlier. And it's driving innovation and investment offshore. The brain drain is real. The capital flight is real. And the ATO's aggressive stance on staking is a big reason why. But if you're staying in Australia, and most of us are, you need to know about this urgent warning. If you're watching this and you've been staking without tracking your rewards, you need to act now. The ATO's data matching with exchanges went live July 1st, 2024. They can now see every exchange account linked to your ID, every staking position you hold on those exchanges, every reward paid out. They're systematically working through taxpayers. And when they find unreported staking income, they don't just charge the tax. They add interest on late payment, currently 7.04% per year, penalties up to 75% of the tax owed, potential criminal charges for deliberate evasion. But here's the good news. If you come forward voluntarily before they contact you, the penalties are reduced or waived. The Voluntary Disclosure Program is your lifeline. Use it. Look, I know this video has been heavy. The situation with staking tax in Australia is heavy. But you're not powerless. Here's your 60-second action plan. Action 1. Right now, 10 seconds. Hit that subscribe button and turn on notifications. Next video drops in 4 days. The wrap token loophole the ATO doesn't want you to know. This could change everything. Action 2. In the next 5 minutes, download the free staking tax calculator from the description. It includes AUD value calculator for past rewards, Strategy Selector Tool, SMSF, setup checklist, links to crypto specialist accountants. Action 3. This weekend, complete your staking audit using the tools I've shown you. That Saturday calendar reminder? Honor it. 3 hours this weekend could save you $10,000 plus in unnecessary tax. Action 4. Right now, comment below with your biggest staking tax question. The most asked question becomes next week's video topic. The staking tax situation in Australia is broken. But knowledge is power. And now you have the knowledge. This is Taxoshi. Remember, what you don't know will hurt you. But what you do know can save you.